Alright, hello guys, and glad to have you on board again today. Everyone would have noticed if you were trading real time yesterday around the CPI's release that the market didn't really like the numbers. So we're going to talk about that in greater details today because I really think this is absolutely mandatory. So let's cut the bullshit on the CPI. So deep dive on what is a CPI number, which numbers actually the professionals pay attention to, which numbers are put in front of the retails so that they go crazy and so on, how outrageously incompetent most of the financial press still is today, and so on. So I'll try to teach you how professionals look at the CPI instead of what is sold to the retails on punchy headlines and clickbaits. So here's what it is, okay? So this is no conspiracy theory or whatever, just teaching you how professionals pay attention to these numbers instead of what's sold to the bullshitters and retails. So this is what it is, okay? This is the whole bunch of data that's going to be available when this data set is published. Sorry, not the last one, though. Here it is, okay? So the beauty of it is that in every economic calendar that is meant to be looked at by retails, everyone's paying attention to the stars, okay? So everyone look at these three numbers because this is where somebody told you that these are the ones the market pay attention to. Once again, who the fuck does that? Because no professional pays attention to these. It's actually quite the opposite. So we're going to do a deep dive of what true IPC numbers are worth it. So the first one, okay, the core IPC. I'll explain very briefly what they are in the eyes of true market professionals. Absolute crap. I mean, IPC core is something in which the weightings of different areas can be adjusted, though they can change it month over month, but each and every year they can recook the number differently, which means, well, studying that data makes no sense. This is a data in which the components are changing over time. So how the heck can you make a long-term study of inflation if you're changing the components on a regular basis? Makes no fucking sense. So damn it, don't ever look at the core IPC. No professionals do that, okay? So these are the cooked numbers, far from reality, and stuff like that. So this is pretty much the equivalent of unemployment statistics in which the retails have a look at the data, the unofficial unemployment data. No true professional does that. Every professional on unemployment looked at the U6 number, which is closer to the reality and can be compared to other countries. Despite that, if you have a look at the real official numbers, 4% unemployment bullshit, of course, you can't compare that number to the rest of the world because it makes no sense. Though don't try to compare inflation in the United States with an IPC core. It's absolute bullshit. The United States are the only one cooking their number that way. So if you ever try to compare it with the rest of the world, god fucking damn it, use the real IPC. Okay, so IPC core, absolute bullshit. Don't ever look at this one. And turns out yesterday, which one was the most staggeringly, outrageously out of consensus? It was the IPC core. Markets was expecting 0.3%. We got 0.6, which is far off. And in that perspective, well, of course, everyone is yelling about the fact that the number is very bad and the Fed is going to give us 100 basis point. Like I said, first of all, try to look at the real data, and then you can eventually try to forecast what the Fed's going to do, which is pointless to me anyway. So this is what it is, okay? Then the second thing, the month-over-month data. How to say it? Absolutely uninteresting, okay? You just need to know a bit about math to know that a month-over-month growth rate on a statistic that volatile, meaning that we just got in COVID, meaning that during COVID, prices have done this, and we've seen that multiple components of the IPC itself are contradictory. Some prices go up month over month, some goes down. It's an absolute crappy mess. So in terms of statistical interest, I would say this thing, to summarize, it is a high level of signal-to-noise ratio, meaning that there's a lot of noise, very few signal to this, because there is lots of volatility in the underlying components of that index. Okay, this is an index. So too much volatility inside the index to consider the data itself relevant. So how the fuck would you study the month-over-month which is the first very short-term derivative of growth rate. So it makes no sense. Looking at the annual version of it would start to eventually make sense because it will kind of smooth out some of the short-term noise, but still, I mean, looking at the growth rate of an index in which the subcomponents are moving erratically, it seems still to me like a weird job to make. So the true thing to look at is this one. We need to have a look at the IPC number, okay? And most importantly, I would say this is the one we need to pay attention to, okay? The pure IPC index, okay? So that's the thing. And finally, I would like to talk about one last important thing, is that the IPC itself has a seasonal adjustment mechanism, which can be tricky, specifically in the current context. So I think that on top of the core cooking, which means we're underweighting some things, we're overweighting some things, and we're putting away some things because they're too volatile. So we're just going to cook our things to do it the best possible way. So once again, until you have a look at all the details and you have something sustainable enough over time, looking at a modified statistics over time makes no sense, okay? So don't look at the IPC core. This is for retail bullshitters, okay? So the true professionals are looking at it. The most important one I would say is the index itself. Look at the raw values, and if you want to look at the growth rate, eventually look at a year-to-year growth rate, okay? That's the only thing that we could pay attention to. And finally, have a look at the seasonal implication. Why am I saying this? Because we're currently in the moment in which the seasonal adjustment is the bigger. Why is that? Then I'll just have a quick look at this very quickly. If we have a look at the seasonally adjusted version against an NSA, non-seasonally adjusted, month over month, we've got 0.6%. On the seasonally adjusted, okay? That's the official core fucking lying number. Though 0.6% is what we got on the retail number. Let's call it that way. The non-seasonally adjusted number is actually negative. So negative, and it was negative last month as well. So the month over month, non-seasonally adjusted growth rate is negative. So without the cookings, the core things, and without the cookings over the seasonally adjustments, we got actually negative growth rate. So, god fucking damn it. When the numbers are going 180 degrees from the others, that doesn't mean that the first one is false and this one is the true one. That just means the reality is probably sitting in between, meaning it's not that bad. It's not good, it's not bad, it's pretty much tainted. This is all I would say, tainted in between. It's shaded gray stuff. So don't try to be dumbly saying the number is very bad, peak inflation is not there, whatever it is, okay? Don't look at it when the month-over-month data says quite opposite things when we look at the cooked numbers against the non-cooked numbers. So probably the reality sits in between because the cooking isn't all badly in and misunderstanding. It's just that, well, it's cooking, so it's just messing with the data. Okay, though, like we said, the thing we pay attention to is the year-over-year growth rate, but on the true index, okay, not the cooked version of it. Though the true IPC index, year-over-year, keeps on contracting, just like it did last month. So, once again, what you see on the core shit is wrong. Or at least we've got opposite data when we look at the true index. So, once again, look right in the middle. It's probably not good, not bad, but it's just not as bad as people think of. The data we see in here is that the growth rate, okay, the first derivative, see signs of changing. We can clearly see that this could be temporary. So, it would still require next month to keep contracting in here to confirm, okay? But that being said, if we look at the real data, okay, this is the one we need to pay attention to. Don't you see a change in here? I mean, you don't have to make math study and stuff like that, being a PhD of whatever in mathematics to understand that something has changed in this shape. We can see the moments in which it changed. The first one is surrounding here. This is where the growth rate started to accelerate. This is where our first derivative in here started to spike in here. Okay, so as you can see, the growth rate accelerates significantly, meaning that the first underlying things start to move faster, okay? though we can clearly see the corroboration with these things. And for 2 months in here, we've seen a decrease, meaning that what does it do to the data? A plateau. This is what we always said. Do you guys think that the prices are going to go down? It's never been the case. Remember the Fed's transitory argument bullshit? That means we're going to get to a plateau. The Fed thought the plateau will go way earlier than it actually turns out to be. But still, I think they weren't 100% wrong. They were just wrong with the timing. We are going to get to plateau, meaning that the prices will stay the way they are for a limited amount of time before, of course, even trying to go on a second climb or eventually try to decline. But we'll get the answer of this month away from now. The plateau area is probably going to last a year. What is it going to do to the first derivative? That means year over year, we're going to tend to go back to zero, okay? The growth rate should contract. So, of course, that would be the perfect flat line. Don't expect this to be, okay? Remember that we come out of a fast rising pace, meaning what we'll get is probably a plateau going slightly higher and something like that, which is going to reduce the derivative. So growth rate is still going to be positive year over year, I guess, but it's going to start contracting eventually. But what matters is that you have to understand, okay, that this phase of rapidly increasing prices is probably going to terminate. And this is what the Fed is fighting against. The rapid increase in prices. So god damn it, look at the data. The data says, well, we need next month. If next month is going rock hot, solid, like at a 300 basis, then we have a problem. That means that eventually we've been going wrong with a couple of months in here, and we're going to restore the trend. But the next number has to be 300 to show us that we were wrong thinking about peak inflation. Because for now, god fucking damn it, it looks like it is peak inflation. It just depends on whichever data you're looking at. You're looking at the cooked, absolutely outrageously stupid core numbers. Are you looking at them on a month-to-month basis, meaning that there is on top of it a seasonal adjustment that makes it absolutely wrong? Or are you looking at the real data? And don't you see that there is a significant change in the data itself? Still requires a confirmation by next month to make it more certain. But right now, I definitely sense a difference. We've stopped rising like we used to. Fuck, look at the data, please, okay? So it's not that bad. It's really not that bad. It's not good either, but it's not that bad. So yesterday's number and their effect on the market, I definitely think it's far overrated. Once again, because the data is misinterpreted by the retails, it's amplified by the stupid economic press, which is making a lot of noise for absolutely nothing. But most importantly, in terms of prices, because remember, that's what we care about in here. Prices have absolutely moved in a dangerous manner, even more than they did when Powell shocked the market when it was at Davos. So it's really shocking the market. But the thing is that putting it into context, is it really that big of a thing? I don't think it is. That's why I've always said, just don't try to analyze the things. Put them into context forever, because that's what professionals do. Remember what we do. In my personal strategy, what I do is that I look at the remaining 5 context boxes to figure out what is happening now, what are the risks, what are the likeliest probabilities, and most importantly, where the fuck are the demand and supply areas? Where are the sellers willing to sell? Where are the buyers willing to buy? And which one of these are we getting to target in the short term? So if we take account of this, the remaining 5 context boxes, the lightest 5 context boxes, show us 2 things, okay? The moving average is in between the context, so we're pretty much in a ranging context. So not the bulls, not the bears are in control of prices. Both of them are actually fighting for prices. The bulls are likely going to support in this area, like the bears are very likely going to fight against in this area, okay? That's what it says. And then I kind of gather all of this subsidiary information that can help me fine-tuning that stuff. So what we can see is that we had a lack of volatility in here. That's what this gray channel tells me. So we were definitely lacking of volatility. That generally means the prices are going to go in between the moving average and the next and closest volatility boundary, and they will oscillate between the two. And then this thing rapidly shifted away right after Powell, actually. We've got this alert telling me actually 180 degree off the previous assessment, which was, boy, this is excessively volatile now, and we're gonna go for the volatility boundaries, okay? Both of them. So since then, since that signal, I knew that there is going to be a probability, an increased probability that the technical tradable area where the low risk trades will actually turn out to be are very likely going to be on the volatility boundaries themselves rather than in between the moving average and the external boundary. Okay? And this is going to last for the next 5 context boxes. So very likely going to last until early October. So till early October, the previous faded low volatility is getting away. Currently, it's actually underlying to the point that it doesn't matter anymore. Though what matters now is this, and it says that this is where prices will likely go. And they were very likely going to hit both ways. We're probably going to go for both of these volatility boundaries. So what we had yesterday, expect that it could be more in the future. So yes, is the market overreacting to CPI? I think it does. Why? Because the technical context says we're very nervous now. And every numbers that goes good, bad, whatever is going to be over-amplified. But remember that the mistake you must not make in this context is to put these numbers away from their actual relative context. So if you're making assessment that this number is so bad that we're going to get 100 basis points and the Fed is going to crash the market or whatever, that will have rippling implication far over the October. What I'm saying is that we have a temporary artificial amplification of news flows just to the sake of creating volatility. And this volatility amplifies human emotions and human perceptions as well. So people get over-emotive over their trades, even though my personal reading on this market says it's going to get volatile, it's going to get stupid. And all I know is that I'm going to trade anyway on those boundaries. My plan says I'm going to buy, and there's no way anyone can sell below 3,900. And that's what I'm going to do. This is the area in which I'm going to buy. In this area, right down to the volatility boundary where the most attractive prices are. This says there is a high chance for us to reach out to those prices if we can get whatever catalyst there is. Could be the Fed or couldn't it be? But understand that all of these timed catalysts, which we know in advance, they are all the timings that can move the market. In which direction? God knows. All I can tell is that for now we're oscillating across the moving average. Up, down, up, down, up, down, up. And everyone is trying to give any sense and trying to make projections, long projections over whatever the short term is giving us. The short term is very noisy. That's what we said. Everyone is trying to impact the market. Central bankers are talking and talking and talking. And like we said, in a stagflation environment, their action is going to be limited anyway. The Phillips curve has already shifted, meaning that, yes, inflation was higher and it's likely going to stay that way. Because in order to decrease 1 point of inflation, you're now going to have to destroy even more on the unemployment side of the equation. So the thing is that the Fed can't do anything with that situation. So playing the Volcker card is absolutely outrageously stupid. The Fed is playing politics here instead of playing economics. Because in the economic side of the equation, they probably know they can do anything. Though they're going to most likely talk, rather than act. And people can hardly make the difference. Of course, neither can I, because I'm not 100% sure that the Fed is going to slow down at some point because they have a limited rate hike possibility and their actions are limited. When on the other hand, we've got Powell talking like he was Paul Volcker. So in that perspective, I would say it's hard to differentiate the true, reliable, potential economic action of the Fed and the political action of the Fed, which is just trying to slow down demand the best they can, using words as well as real actions. But they're most likely playing with words. So I'm pretty much concerned with what's going to come at the 21st of September, because I expect the actions to be tempered, but I expect the words to be harsh. And I don't know how the market is going to react. All I know is that if prices are going to the Bollinger Band, I'm going to buy, because that's what I have to do. Okay, I'm going to buy any signal anytime we dive into this buyable area that I've mentioned. I'm going to need signals to do so and to risk limits, and the better the signals, the more aggressive I'll be in the position sizing. And if there are no signals anyway, I'll buy the Bollinger Bands. Okay, so this is my strategy, and it hasn't changed. And the CPI numbers, cooked or non-cooked, haven't changed anything to that forecast. When it comes to cryptocurrencies, though, it's the same old story. Yes, we can see that yesterday has been a painful session, but it's doing quite the same. We're trading across the moving average in here, and remember what I said. We are in a particular context in which the moving average has gone absolutely outrageously vertical, just as the higher time frames have moving average that are still rising. Okay, the daily has a moving average that is still rising. If you do the long-term linear regression for those assets, the linear regression, which is the best or the closest thing that goes against value, is still rising. And we have gone to excessively undervalued territory on a very fast and painful manner by retroactive or by negative feedback loop, which has created downward price pressure. Remember that this is the kind of context in which we can get the exact opposite of over-amplified price structure. When prices deviate severely from the mean value, they go outrageously bullish by automatically fueling feedback loops, speculative outrageous demand, speculative bubble. These things go from bullish to bearish. Okay, and they go back to mean value over time. There is the exact opposite for massive devaluation. This market generally tend to retrace that way. They will grind their way back up to value, and there will be no lower low or higher lows and long contractions and so on. If that is still the motive, then expect Ethereum to just pull out of this range, go back to the volatility boundary, build another range, and so on until we get to the value, which I still expect to be around 26 to 2900. Okay? This is what it is. As long as this pattern plays out, well, whatever happened yesterday, I don't even see it on a daily chart. It feels like the random noise which we've gotten used to recently. So please don't try to over-amplify things. I've seen so much bullshit like, oh, now there is a bear flag. Please, please, please. We're in a range, okay? So as long as we don't break that or that, there's nothing to talk about. There's no such thing as a bear flag or shit, okay? Please, 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 guys. I know technical analysis is complicated. I know so many people on YouTube are trying to make it easy. It's not, okay? Just understand that the current value we're trading across is 1700 or so. And we've just absolutely perfectly oscillated across this level. So please try to make it easy on you guys. We're ranging across this level. As long as we don't break the boundaries, there's nothing to talk about. Yesterday might have been a painful day because 10% drawdown in just a few hours. That means something huge might have happened. Inside ranges, nothing huge happens until we break the boundaries with closes. So please, until then, don't try to drive yourself crazy. Okay? That's going to be today's feedback. I'm sorry, I'm generally doing this in a recurring manner for now, and it's been lasting for long, but I know we're currently trading in very painfully psychologically impacted times. This is the reason why market psychology is very important in here. It's the factor that will make the difference between those who will succeed and those who will fail over time. Because I expect these markets to go even more psychologic in the next few weeks until we finally get a clear sight. But as we're trading ranges inside ranges on many consecutive time frames, people are getting lost. So understand that we're in the bottom of weekly ranges. This is not an area to sell. Just try to make it easy on you guys. If you bought the lows, just be patient. You bought on weekly chart time frame references. So don't let yourself being influenced by an ugly 4-hour candle. Okay? And more importantly, those 4-hour candles, no matter how ugly they may look like, they're in the middle of ranging areas, out of moving averages across moves. God damn it, just don't try to give them too much credit. Okay? And most importantly, the economic press is very, very much full of people that are just as incompetent as they've ever been in the 10 years that I've seen in the markets. They're really getting worse every day. Though it's crazy how clickbait bullshit there is all across the board. Most of the time, people interpret the worst numbers, those that make less of a sense. So this is the lesson I'd like you guys to listen to today and to learn from. Most of the time, the data is not the one that is put in front of your face by headlines and stuff like that, or false fake professionals on YouTubers, whatever bullshit. Most of the time, the bad traders are just looking at the wrong information. So that's what it is, okay? I'm not saying this is conspiracy theories or whatever. I'm just saying raw mathematics. The real numbers are always the best. Don't try to look at derivative cooked versions of things, okay? The more the data is cooked, the less reliable it is. And that's also working for the same old stupid labor statistics numbers that we get each and every month as well. Don't look at the real unemployment numbers that are so-called cooked, but look at the U6, okay? U6 unemployment is what's closest to the pure data, okay? Just like when it comes to PCI and stuff like that, look at the raw numbers, not the fucking derivative month over month, and pay attention to the fact that there is a core alteration to the value and a seasonally adjustment on top of it. Too much price manipulation to me, okay? So look at the raw data. It's always going to be better. That being said, this raw data, like we said, is looking signs of a plateau, which is exactly what we want for peak inflation. So far, it does look like peak inflation is here. What the Fed is going to do on the 21st, I think, is 75 basis points, which has been the case all along, due to the fact that we're still following the same model of the US 10-year yield, which shows we're going to get a 75 basis point granted now. The 100, I don't think so. And if we do get a 75 basis point, it's more likely be all around the wordings, the choices, the political of the Fed, which is going to move the market. Because I don't think we're going to get anything more than the 75 basis points. I'm not 100% sure, and I'm not gambling anything. All I know is that even if we get a 100 basis points, and if the prices go down to the lower Bollinger Band, I'm going to buy, because that's the plan. I may eventually end up with a stop loss, but that's the huge difference between professionals and retails. Retails trade because of what they think the future is going to be made out of. Professionals trade out of patterns, and they don't give a fuck about being right or wrong. The market will make the decision in the end, and we all know that. So try to trade that way, because there's one thing I know for sure. Money always goes from the lower and the weakest pockets to the deepest and the smartest pockets. And there's one thing I know for sure. You'd rather like to be on the smart side. Bye, guys.